Hey there, Blockhead Traders. Here, Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of March 23rd, 2025. And in this week's episode, I'm going to touch on an earnings trade that I put on OKTA recently. And this is one that did not go as planned and basically breached the call side and went into the money. And I've deployed a few different management techniques to it. And we're going to talk through some of the different plays that I put on to try to manage this loser to battle back into a winner. And it's an interesting thing because we're going to touch on an option selling technique called a straddle. And that's not something I normally deploy, but it is something that I have converted what was an earnings strangle into basically a protectionist straddle. And I'll talk through that in this week's episode. Before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, as well as /ViperXL007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so subscribe to us there, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week's content, I want to take a look at an earnings trade that I put on OKTA. And just to recap a little bit, if you're new to the show, earnings trades are something that I like to put on quite regularly. It's quite convenient that they come around 4 times a year. But what I'm doing when it's earnings season is I will screen for things with elevated volatility. And what I will do is I will look over the weekend for what trades are coming up that particular week. And I will look at all the different companies that are reporting, and I'm going to look for companies that have very extended volatility relative to themselves. So anything kind of above 60 percentile of historical volatility, that's something that I'm going to consider trading and selling the option to. And reason I do that, and I also look historically to see if earnings normally give a big volatility contraction. You can tell that by looking at the chart. You plot volatility below the chart, and then show where the earnings are. And if you see a regular drop in volatility around the earnings announcements, that is a particular company that historically has a contraction in volatility. And if that company is elevated volatility going into earnings, that's exactly what I like to play. And the reason that I do that is because it has a very high probability of winning. And what I mean by that is when you have the volatility that's so high and so elevated, a lot of times the market overstates the volatility. It's just, think of bad news or when panic happens, right? Most people over panic or overreact to any particular situation. And so if you have an underlying that is very volatile, a lot of the traders will overestimate that volatility and cause a very wide range in the option premium. And so what I will do, or at least in the option pricing, I should say, not the premium, but it goes into how far those strikes are to get a 16 delta. So I will typically try to sell a 16 delta strangle going into earnings. And what that means is I will sell a 16 delta call and I will sell a 16 delta put same time. Now they'll be at different strikes, and this is what is known as a strangle. And when you sell the strangle, that 16 delta is going to be some percentage move from where the stock is. And what that percentage is really depends on the underlying, really depends on the volatility, and all of that stuff. But going into OKTA, this was something that the earnings had a lot of volatility popped in, and OKTA had historically had a huge volatility contraction after earnings. And so going into it, I opened up a 16 delta put, and that 16 delta put ended up being 105 on the call side and 80 on the put side. Now, OKTA reported earnings, and they did really, really well, and the stock took off to the high side. And I'll pull up one of the charts here to show you that. And I'm also going to have on this chart a bunch of red boxes, and those red boxes are going to be all of the different options that I have sold. So let's go ahead and take a look at that. All right, so right here, we've got the OKTA chart, and you'll see a ton of red boxes, but let's focus. We'll go left to right, okay? Now, these are all the different plays that I put on, but the most important one is this very first one. And so when I opened this up, I opened this up right here on March 3rd, was a Monday of that week. Now, OKTA reported earnings, I believe, on the 4th, so the second day into the week. But you can see just before earnings, OKTA was trading around $90. And so that 16 delta put was biased to the call side. So the option pricing was telling you that the market saw risk to the upside. So that 16 delta on the upside took you all the way to a 105 strike, which is where my top side call was. And the 16 delta put was actually an $80 put. So it was only $10 to the downside, but $15 to the upside. And what that type of pricing, that's called a call skew. And what that's telling you is the option pricing is saying there is a lot of risk to the upside. And that's another way of saying the traders think this stock is going higher after earnings. And so I go ahead and I sell that call and I sell that put, thinking, the idea is you stay below those two strikes. And the reason you would stay below it is because volatility is overstated. So the amount of movement that is going to come off of that underlying after earnings won't go as high as people think prior to earnings. So that's what these first two boxes, and this one ends here on March 6th. And then this box down here actually goes all the way to March 7th. So remember, I will put the trades on a Monday. So it doesn't matter what day that week they report earnings. I will put on my Strangle on Monday for the week of the earnings announcement. And I will sell with expiration of that Friday because I want all the volatility, all the contraction to go poof. And basically, hopefully that option is worth nothing right after the earnings announcement, and I will close it out. Now, what happened here is we had the earnings announcement and we popped up. So this is 4 hours, and we opened the trading day what looked to be good, right? We're at $100. That was the previous high here back in February, and I didn't go super far back in time, but I said, hey, that's going to be an area of resistance. And this is something where I'll go ahead and, I'm comfortable with a strike above that. 105 was above that 100 level. And we even got this pause, after the market before it all opened. But we just kind of continued higher. So up and away we went. We breached that 105 strike, and volatility is out of this thing, contraction, all that stuff. So what did I do? Now, I did a couple of things. The first thing that I did was there was no way in my mind that we were coming back down to this $80 put. So I'm going to go ahead and let that ride into expiration. So that's why that goes all the way to May 7th or March 7th. Now, the call side, I didn't really want to get early assigned. And that's something that you'll hear me talk in past videos is make somebody early assign you. Don't just go into expiration going, well, I'm breached. I might as well sit here in the money. Make somebody take early assignment. And so what I did was I rolled. So I closed out this call deep in the money, which was very expensive to close out. But I turned around and sold the next month. So when I roll from an earnings trade, I will roll to the next monthly expiration. Now, because this was expiring March 7th, the next monthly expiration was March 21st. So that's why this next red box is here. It was opened here when I rolled out on March 6th, and I took it all the way to March 21st as the expiration. And I kept the same strike. Now, so all of that in the money value that makes that option so expensive to buy it out to close, you get it right back when you sell. So it's kind of a little bit, all you're dealing with is the extrinsic value. So it's kind of a wash, the in the money portion. Now, because we had breached this and we'd already gone above this 100 strike, I said, you know what might happen here is we might come back down to test that 100 level. But this was a very bullish report, and the overall trend was it likely could take off on the bull side. So I sold a 100 put. Now, I did this to basically try to collect more premium because I have broken through the call side, gone in the money, and I am in the hole on this trade. So I try to bring up my put, sell more premium to collect more money to take my debt down, and I'm going to roll out the call in time which will also allow me to collect more premium. Because every time you roll, because you're going further out in time and you're keeping the same strike, you will always collect more premium because there is more time. Time equals money, just as in many things in life. And so you can collect more money. Now, we then came to the end of March 21st week, and we had not gotten back down. Now, we hadn't gotten above this 116, 115 level. This has been a little bit of resistance. And so I'm still of the opinion that we are going to get this trace back to retest this 100 level. And we haven't really done that yet. We came back and we tested a 105 level, but we really haven't come back down here to test. So what I have done here, you'll see these red boxes are touching. That is called a straddle. Now you'll notice the boxes don't end at the same point. That is because I believe that now I'm starting to play a little directional with the options. And I believe that we will likely get lower here in the short term before continuing higher on the long term. So I'm looking for a test back here to maybe a 100 level, a bounce off of that level, and then gaining from there. And if that happens, I don't want this call going out to the next monthly expiration. But for this put, I am okay going out to the monthly expiration. And a lot of times I like selling options on monthly expirations because there is way more volume. And the more volume you have, the more liquidity, the more fair the pricing. So whenever I can go out to a monthly expiration, I do. The only deviation I make on that is when it's an earnings trade, I do week of expiration. And in cases like this, where I'm rolling, I only want to roll 1 week at a time. So the call side, I have decided to roll from same strike, same 105 strike from March 21st, and it's going to go out in time to March 28th. And the idea here is that I want to sell this. I sold, bought back the in the money here, and then turned around and sold in the money. So as soon as we come down, if we get close to this 105 strike, I will probably close this out. The reason is because I'm kind of chipping away at all of the premium and my debt that I have. And as soon as I get down here, that option price should go close to zero. If it drops below 105, that will be the most perfect condition because that's really where I'll be able to close it out for negligible and capture all of that in the money ness that I have kind of messed up as we breach through. Then the idea here is this trade from 105 on the put side will continue out to the April monthly expiration, and believe we're going to go higher, so I'm never going to own these shares. But honestly, looking at a longer term chart of OKTA, I would be okay owning shares of OKTA if, for whatever reason, we ended up breaching this 105 and I might get early assigned. I don't believe that's what's going to happen, but it is something that I have to prepare for and I am okay with. So this is the Flappy Bird chart and where it looks at. So what does all that look like on paper? Because there's a lot of red here. There's a lot of things going against my trade. And you might think, oh my gosh, how is this going to work out for you? So here's the table that I'm talking about. Now on this table, right, originally this was an elevated volatility earnings trade. We breached on the call side and I'm basically battling back the premium and I battled it into a straddle where we're currently sitting as we go in towards the March 28th expiration on the call side, and then later the subsequent April 17th expiration on the put side. So on March 3rd, I opened up that short strangle. I actually did 5 of these. They expired on 3/7, and I was able to open that trade collecting $13.25 in premium. Now, this breach to the call side. So I was deep in the money when I needed to roll out that call. So the put expired absolutely worthless. So of that $13.25, the portion that was the put, I got to keep that. However, the call, I ended up having to close for some cost. That net closure cost me $5,800. So right there, that's what I'm talking about. I'm now $44.75 in the hole that I have to battle out of. And so to help battle that out, I basically opened up 5 of those short puts at the 100 strike. Now, these I did not get a lot of premium for because this was post earnings. So earnings came out on 3/4. And what you saw there is now we're after it. Volatility came out. So selling that 100 put, not so lucrative. I was only able to collect $315. Now, Good news is that expired on March 21st. That expired absolutely worthless. So I kept every penny of that $315 to work down my debt. Now, I rolled out, I waited, hoping, at least help me out and let's get some more premium. Let's get closer back to the money on the call side before I roll it. So on March 6th, I rolled the call, that 105 call. All 5 of them I rolled out to the March 21st expiration because that was the first monthly. Now, in doing that, that was very deep in the money, so I collected $6,175 from that. And you might think, "Oh, great, there it goes. You're out of the hole. You worked off your complete debt." Well, not really, because I need that option to close below that strike price in order for me to capture back this in the moneyness. And so far, that hasn't happened. So I needed to basically roll this trade into that straddle. And the straddle is when you're selling a put and a call at the same price, the same strike. And that's basically what happened. I did 5 of them. Now, they did different expirations, and the call expires first. The put will carry on farther. But in order to close out this 105 call, I had to pay $48.05. Now, good news is that was less than I sold initially, so I collected $13.70. That actually goes to work down my debt. And then when I sold the 105 call for just that one more week of expiration, I was able to collect $49.80 on that. Now, how much of this $49.80 I'm going to get to keep, we don't know, because we have to wait and see how that pricing goes going into March 28th. But I can promise you, as long as I'm not early assigned, I am going to roll that if we are not out of the money. And I'm going to repeat that 1 week at a time, either until the price action shows we're going higher, which basically means we need to break 116, 115, retest it, and carry on. So if that happens, then I probably will take a big loss on this and exit this, because there's no sign of when it's going to stop going up. Now, I pulled up the put to a 105. So this is the 100 put, but we're still up here pretty deep in the money. So I pulled up that 100 put to a 105 put, which gives me closer to the money, which lets me collect more premium. I did 5 of these. I went all the way out to the monthly expiration in April, and I collected $705 for that. Now, again, how much of that do I get to keep? We won't know until we get closer to that expiration. But if this stuff works out and trades the way that ideally it should, in my mind, then what we're going to end up doing is adding up all this. We'll collect these things close to their full amount, because I will close them out for small pennies if they're truly out of the money. And this is currently consuming $10,000 of buying power, but I will have netted almost $2,900 in premium. And so if you divide that out, that return on capital is about a 29% return on capital, which isn't too bad for what will probably end up being about a month to a month and a half trade. So think about that it would be a 29% return on about a month to a month and a half. Now, will we get up to 29%? No, we'll probably be a little bit lower. Realistically, I'll still close these out for a few dollars. Probably cost a couple $100 to close out the call, a couple $100 to close out the put, and you're probably looking at around a 20% return. But a 20% monthly return is not too bad. And worst case scenario, we end up keep going higher, and I end up closing for a loss. But even the other scenario would be that we get to close the call out, but we just continue down lower and lower, and I get assigned OKTA at 105 from the put side. But I'm okay to be long OKTA shares. So, that's really how a lot of this stuff can play out. So that brings us to the end of this week's episode. Hopefully this just gives a different flavor and a different exposure to how you can kind of manage some of these option trades that will inevitably go against you. And you have to remember that you need to have a strategy going into these trades before you're in them. And for me, that is you roll the breached strikes until you kind of battle it back. And for the unbreached strike, that's where you're going to pull that thing up. You might, go inverted like we talked about a few weeks ago, but you're going to keep collecting premium to work down that breach of the strike. One of the strategies could just be to get out and take the loss. That's not my strategy before I lock in that loss and want to say, yep, this is truly beat. I'm truly done. I'm going to fight and battle for it a little bit. And so right now with OKTA, I'm battling. If we end up breaking that 115 strike, closing above it, retesting it and bouncing off of that, then we're likely consider going higher. And that's really my worst case. That's where I'll bail out. That's where I'm going to take a pretty big loss there, as that will be about $10 in the money on these 5 puts now, or these 5 calls. Now, hopefully I will have eaten down some of that impact of the loss by the puts that I've been selling, by the rolls of the call, and it won't be as terrible as if I took that loss right out of the gate, but it's something I'm going to push for and I'm going to go through. Now, the best case scenario is I end up getting to close out all of these management options for close to zero, as there will be out of the money before their expiration. And in those cases, I basically will end up with, about a 29%, 25 to 29% return on my capital for about a month and a half. And that's really good. I target about a 6% return monthly in my overall portfolio. And so I'm going to have some winners, I'm going to have some losers, but I really like my winners to end up being typically in about the 12 to 18% return on capital. So this one has the potential to be greater than that, but it also could fall in a different range. So we'll see how it goes. We'll keep you guys posted. Hopefully this gives you something to think about. Hopefully you're finding things that are interesting for you to trade out there in the market. So good luck out there. And remember, think outside the block.